Last Friday, August 2nd, the markets got rocked by an employment number that was worse than expected, quite a bit worse than expected. So as a result, the market on Friday especially, and the market today, Monday as I'm recording this, have had pullbacks or significant declines. So I'm going to address this. The issue here is perception of what's going on. I have 4 points of view that I'm going to play for you, all of them different, and I think helpful to understand what is happening and how you respond to it. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is August 6, 2024. I'm going to begin with a piece from an interview that Jonathan Ferro at Bloomberg does with Claudia Sahm, and she is the founder, originator of the Sahm Rule, named after her, and she came up with this formula. And so I'm going to play that, and it's a little bit complex. It's more kind of economic. So if you're not into economics, it seems kind of weird, but it has worked. It's been accurate a lot in the past. So I wanted to read this. This is a description of what the Sahm Rule is. So as she's talking, at least you have a context for what she's saying. And this says, there are many recession indicators that economists look to determine whether or not we're headed into a recession. One is the Sahm Rule, created by economist Claudia Sahm. According to the Sahm Rule, if the average unemployment rate over 3 months rises to a 0.5 percentage point or more above the lowest 3-month average over the previous year, we're in a recession. Now that's kind of complicated. But anyway, the July labor report triggered the Sahm Rule, and that doesn't mean we're in a recession. It means we're headed into a recession. So when Claudia Sahm, she's going to be interviewed by Jonathan Ferro, when she speaks, she will be talking about the labor market, because that's what the Sahm Rule triggers off of, and she will make the point, we are not yet in a recession, but because it got triggered, we are headed, according to her and her rule, we are headed into a recession. And because of the accuracy of the Sahm Rule, Bloomberg and others are paying a lot of attention to this. So take a listen to Claudia Sahm.
I just want to take a beat and just sit on this for a moment. Claudia, let's go from the very beginning. Tell us what the Sahm Rule is, what you wanted it to be used for, and whether you think it's applicable in a labour market like this one.
So the origin of the recession indicator was in a proposal I had to improve fiscal policy, put it on autopilot, automatic stabilizers in a recession. It's a rule in the sense of not the economy must do something. It was a rule in the sense of policymakers do something. It may end up playing out that way. But what the idea of it was to look at the historical record in the United States and find the pattern, find the unemployment rate increase. It's very important to look at changes at which, in the past, the U.S. has been in a recession, months into a recession. This is not a forecast, right? And so it's just trying to capture. And yet it is absolutely true that it doesn't have to be that way this time. And frankly, if we look at all of what we know about the U.S. economy, right now, it is very unlikely that we are in a recession. And yet a really important question is, where are we headed? And those changes in the unemployment rate that the Sahm Rule picks up on, they do not look encouraging, right? They're headed in the wrong direction. And that momentum is what can get us in trouble.
So, Claudia, for just all of those people out there who are talking about your name, who are talking about the Sahm Rule, using as an excuse to sell, using as an excuse to say that the Fed should be moving sooner. Just what do you say to those people?
Calm is important in a moment like this, regardless of what indicator or data point you're looking at. The fear does no good. And this, again, this was trying to give a simple summary of one piece of the U.S. economy. The labor market is very important. There's a lot of complications right now. Again, it's this balance between but take it seriously. Right? Like there is slowing in the U.S. economy, and we have seen that. The point is to keep that slowing from really pulling us in reverse. We're not there yet. Usually the Sahm Rule, by the time it triggers, we're past that point, right? So there is this opportunity of, as I said, the Federal Reserve has a lot of place to ease. We do come into this in a position of strength, broadly speaking, in the economy. So that's really important for weathering a storm like this that has many different contributors to it today.
Next, Andrew Sorkin from CNBC is interviewing Tom Honig, who is the former president of the Kansas City Fed. And he makes the case that we are in a weakening economy, but that there is no reason to panic. And when he says that, most people are focused on their own investments, my portfolio. And I want to make the point that, and he makes the point, the stock market or your investments are not necessarily correlated with the economy. Sometimes they are correlated, and there's quite a few times they are not. In other words, the economy will go in one direction, your investments will go in another, and it goes on, and you think, well, wait a minute, the economy is weak, why aren't my investments going down, or vice versa? And so I think he makes a good point that there is no reason to panic. And the Fed, he makes a point that the Fed will likely lower interest rates in 50 basis points, 0.5%, which is a lot, in September. There is the possibility, if things got worse quickly, they've done this before, that if things got bad quickly, they could actually call an emergency meeting and do a teleconference with the Federal Reserve, the Federal Open Market Committee, and do that via telephone and make a decision to lower interest rates before the September meeting. I don't know that that's going to happen. He was kind of cautionary when he talked about it, but that could happen. So the Fed is going to respond, as so many have said, Mohamed El-Erian and others have said, that the Fed is so reactionary that they're not proactive at all. They wait for data, and they wait sometimes too long for data in order to respond to it. So we're always dealing with this trying to catch up mode. But anyway, here's the interview with Andrew Sorkin and Tom Honig.
It's great to see you, and I appreciate it, especially given where things are starting this morning and what we saw on Friday with the jobs number, and then this sell-off that seems to be spurred in part by some uncertainty in Japan that then sort of cascaded here. What do you make of what happened Friday, and what do you think of what's happening right now?
Well, I think, first of all, the economy is apparently slowing. I think everyone now recognizes that, perhaps, but that's as intended. I mean, the Fed's been in a relatively tight mode for some time to try and get the inflation numbers down. So I'm not sure anyone should be surprised by the numbers. It was a little bit on the upside, perhaps, but unemployment is still 4.3%. Inflation still between 2.5% and 3%, depending on which of the two measures you look at. So we are in a slowdown period, and I think that's going to take us further down the road to getting price inflation down towards the goal. Now, the market is reacting, and the market was, many people thought, in a fairly frothy spot to begin with. So that's backing off. But I think the real economy is slowing modestly and will probably continue to slow. But it's not falling apart. I mean, GDP was up in the second quarter. Final demand, while it's leveling off, is still reasonably good. So those are important things to remember as well. And then finally, real interest rates, if you think about the rate, the Fed funds rate being 5.25% plus, and inflation 2.5 to 3. Real rates are still above 2%.
Right.
But I think that's by intent to bring it down. So there's probably room to cut, and I think the Fed will do that. But I don't think we should be panicked.
Next, I'll play a piece from Tom Lee. He is the economist, chief strategist for Fundstrat. And he says, now this is interesting, Japan, the stock market in Japan has fallen by 20%. And that the general market has sent a trigger into the U.S. market, and the U.S. market is responding. So he thinks that the market here will be unstable until October. I'm just going to say, I'm recording this in August, I'm just going to say that's a couple of months out. Maybe it's a little more than that or a little less, but it's in the neighborhood of 2 months if you believe what Tom Lee says. This is likely to be a down period, and he identified with Joe Kernan's question of that it goes down sharply, but then on the other side, it goes back up sharply. And if it does go down sharply, that is likely to be the response. So, and I thought that was an insightful comment. So take a listen to Joe Kernan and Tom Lee.
Let's bring in Tom Lee, Managing Partner, Head of Research at Fundstrat Global Advisors, as well as a CNBC contributor. In times like this in the past, it always would help to know, Tom, whether it's a sharp, scary spike down, which a lot of times the other side looks just like it, or people are hoping for that so much that they don't see that it might have longer to go. Do you get the feeling that this is not going to be a major sell-off?
For now, I think it is the former that you described. You know, we have over 3 days, suddenly markets reversed and, you know, Japan down over 20%. And as you're pointing out, the NASDAQ could even, you know, decline further. Declines like that are generally symmetric, but you have to watch the VIX. And when the VIX peaks and starts to roll over and fall down, the recovery can be just as quick. I think a lot of this depends on whether financial conditions in the U.S. start to tighten, you know, meaning like, do markets seize up? But with interest rates falling, you know, the consumer's still in pretty good shape. I think on the other side of this, it'll look like a growth scare. But it doesn't mean that
it's a
today's
growth
the bottom.
Scare.
Yes.
It's kind of interesting that it almost looks like the Fed, the market's doing what the Fed didn't do again. It's almost like once again they're there, but not really ahead of what's happening, and they're reacting, not anticipating, kind of again.
Yes.
On the way up and on the way down.
Yeah, the 2 years is signaling that the Fed is behind because 2-year yields have fallen further. But it does seem like, as we look back a lot more, this is because of the surprise hike from Japan and the sort of knock-on effects from there. If that is the primary source of the reaction, I know it's going to be tumultuous for markets, but for the U.S. economy, it's not necessarily bad news. And I think that's why we can balance.
Now, I want to give you another perspective. This is a little bit, you know, kind of like Tom Lee. It's also a positive perspective. And this is an interview that, again, Andrew Sullivan did. He did it with Dan Ives. And Dan Ives is a money manager. And he says he believes we are still in a bull market, that this is a decline. It's a sharp decline, but he thinks we'll bounce back and this will continue on to be a bull market. So if you're looking for some positive indicators or positive news, I'm always glad to show both sides of this. And I think Dan Ives is a respected money manager. Take a listen to Andrew Sullivan and Dan Ives.
The global sell-off intensifying this morning, led largely by tech. I want to bring in Dan Ives, Managing Director at Wedbush Securities. We're looking at the NASDAQ now off about 856 points. Of course, Apple, NVIDIA, some of the big laggards. Dan, what do you make of the sell-off? It's a falling knife at the moment. Do you want to catch the knife?
Yeah, I mean, look, for us, we're navigating investors through this white knuckle moment. in terms of looking at the tech names and the winners, what I believe is going to be this AI revolution. Look, there's no doubt that investors over the weekend and today call and trying to say, is this the end? Is this the end of the tech bull market? I don't believe it is. I believe this is just a massive fear panic that will create the opportunities for NVIDIA, to own Apple, Microsoft, Amazon, Alphabet. And that's always been our playbook the last 24 years covering tech.
So when clients call you this morning, are you telling them to buy on this? We'll describe it as weakness, but boy, it feels like it's more than weakness.
Yeah, I mean, we've been basically, I'll say almost table pounding in terms of put the levels, put the names that you want to own that I believe are really going to view this as more of an opportunity rather than as sort of catching a falling knife because of where the growth is. You look at earnings, you look at the numbers. I mean, I'm here actually in Tokyo, and across Asia. The demand is here for AI. That is not leaving despite what we're seeing with this Nikkei sell-off here in the global rout. That's what we're telling investors across the world today.
So thank you for those of you that write me. You send me emails or you respond and put them in the comments section. Thank you for that. I had a listener who was from New Zealand, who is from New Zealand, who wrote me an email and a long email about what he thinks is going on, which I happen to agree with him. And then in that, he sent a cartoon. So I wanted to show this cartoon, and I want to give him credit for it. And so thank you. The Federal Reserve could be correlated or identified with the unicorn. And I thought this was apropos. A lot of people don't agree with the Federal Reserve. Keep in mind, they're not federal. They're owned by the banks. So federal is a name they put on it to try to get the vote in 1913 by Congress. And reserve, they have no reserves. So they're deeply in debt, and they print money and they adjust interest rates and other monetary policies. So if you're a big bank or a big banker and you like the policies of big banks, you would probably like the Federal Reserve. But if you're not, you realize they are actually manipulating us and manipulating our economy for the benefit of the big banks. And so anyone who disagrees with them and what they're doing and how, transparent or non-transparent they are, I agree with those comments. So thank you to the gentleman who sent me this cartoon. Thank you for watching. If you have questions or comments, leave them in the comment section below.